evening. We are in. Yesterday we have discussed about this banking companies. Okay, Form A and Form B. And regarding that, there are some important points that are to be discussed. What are the points that we come across? Okay, important items. Money at call and short notice. Yesterday I told you that whenever you come across, okay, it represents temporary loans to bill brokers, stockbrokers, and other banks. If the loan is given for one day, it is called money at call and short money at call. If it is repayable at a short notice, usually 3 days, then it is called okay short notice money at short notice. Okay, these things they'll appear in the balance sheet. That is, when you take into account the schedule number 7, they'll appear in schedule number 7. Okay, next, advances. Advances includes loans, cash credits, and overdrafts, and bills discounted and purchased. Loan loan is an advance of a fixed amount to be withdrawn by the customer in lump sum. That is nothing but the loan that we come across. Sure. Okay. Loans may be loans repayable on demand or term loans. Interest is charged on the total amount of the loan granted to the customer. The rate of interest is lower than that charged on cash credits. Okay, cash credit. It is an arrangement by which the bank agrees to lend up to a certain limit. Interest is charged on the actual amount withdrawn by the customer. Interest is charged at a higher rate than that of charged on the loan. Next, bank overdraft. What is bank overdraft? Okay, whatever it may be, the excess money that you withdraw over and above the deposit amount. Excuse me. Over and above the deposit amount, we'll call that thing as bank overdraft. And this bank overdraft you will come across only for current accounts, not for savings accounts and fixed deposits. Okay, whenever you come across demand deposits, then only you come. Next thing is branch adjustments. Okay, branch adjustments. Okay, what is this branch adjustments? See, you will have a bank and it will have so many branches. And when one branch, when it is shortage of money, then it will, instead of going to the head office, it will go for the branch, that is co-branch, and it will take money from that. And whenever the branch, when it is having excess amount, it will repay the amount to the co-branch. So instead of going directly to the head office, the banks, sometimes what they'll do is they'll contact their co-branches, okay, co-branches, and they'll satisfy their wants. That is the necessities. That is about branch adjustments. Several transactions take place between head office and branches, and also between one branch and the other. The necessary adjustments have to be made in the books of head office. Some entries may remain unadjusted on the closing date, and the branch account may be either debited or credited. Okay, may show some balance. This balance is called inter-office adjustments. It may be either debit or credit. If it shows a credit balance, yesterday itself I told you that. If it shows a credit balance, it should be shown in schedule number 5. And when it is showing a debit balance, it must be shown on the asset side in schedule number 11. So non-banking assets. Okay, what are these non-banking assets? A bank is not allowed to purchase or sell goods, but it can lend money to its customers on the security of assets, okay, including goods. If the borrower fails to repay the loan taken by him, the bank will acquire the assets in satisfaction of its claim against the borrower. So those things we'll call them as non-banking assets. Okay. The assets will be included in schedule number 11, other assets as non-banking assets acquired in satisfaction of claims. So this is also very, very important. And after this, we are coming across, okay, non-performance assets. Non-performance assets. So what are non-performance assets? Let us see. Okay. See, non-performance assets, non-performing assets. What are they? Okay, most of the loans given by the banks have become overdue, and some of them have almost irrecoverable. Okay, you cannot recover those things. But the banks are taking interest accrued on such loans into profit and loss account. Okay, so what they will do is, whatever it may be, the interest accrued, they'll take that into profit and loss account. So with this, what will happen is, okay, you won't come across a good profit amount or a financial position in a good manner. This practice shows a false picture of the balance sheet and the profitability of the bank. Therefore, to put an end, okay, to this practice, RBI and the government people decided that banks should make provision for such non-performing assets. Okay, a non-performing asset, NPA, is defined as a credit facility in respect of which interest has been remained unpaid for a period of 3 quarters from the date it has become past due. A credit facility is considered as past due when interest is not paid for 30 days from the due date. The period of 3 quarters will be reduced into 2 quarters in 1994 to 1995 and in future to reduce it to 90 days as per the international norms. This is about non-performing assets that we come across. That is, whatever it may be, the assets that remain, okay, loans, when they are become overdue or when they are irrecoverable, interest accrued must be taken by the banks. So these things, in order to curtail that, okay, we have to take into account this credit facility, and we have to take into account, we have to charge the interest, taking into account the time period, 3 quarters. Okay, like that, you will come across non-performing assets. Next, acceptances, endorsements, and other obligations. What are they? In case of foreign trade, the seller of goods does not deliver the goods to the buyer unless he is sure of receiving the payment. As the credit worthiness of a bank is much more than that of a customer, he takes the help of his bank for this purpose. The bank may accommodate his customer in any of the 3 ways. What are they? So suppose if you are purchasing goods from a foreign seller, the seller won't deliver the goods until you pay the money. Until you pay the money. So in such case, okay, as the credit worthiness of the bank is much more than that of customer, he takes the help of the bank. So here we have to go for the bank and we have to take the help of bank. And the bank, it will assist the customer in 3 ways. What are the 3 ways? Let us see. By accepting a bill on behalf of the buyer drawn by the seller. Second one, by making an endorsement on a promissory note prepared by the buyer in favor of the seller, and by giving a guarantee to make the payment if the buyer fails to pay. All these things the bank will do on behalf of the buyer, on behalf of the customer. In all these 3 cases, the primary responsibility for payment is that of buyer, on whose behalf of the bill is accepted, endorsed, or guaranteed for payment. Banker's liability is contingent only on the failure of the customer to honor his obligation. Therefore, acceptances, endorsements, and other guarantees given on behalf of customers are shown under the head, okay, contingent liabilities, okay, at the foot of the balance sheet. So this is about the acceptances, endorsements, and other obligations. Bills for collection. These are the drafts or bills drawn by sellers of the goods on buyers of the goods and deposited with bank for collection. At the end of the year, the bills which are received for collection but remain uncollected are shown as bills for collection at the footnote of the balance sheet. So these are the various items that we have to take into account when we go for banking companies. And after this, we are going for adjustments. What are the different types of adjustments that we come across? Okay, with this, I'll stop. And in next video class, we are going for these adjustments. Thank you.